When you buy a stock, you're buying part of a company. And no matter how much you love that company, how cool the brand is, how inspiring the mission sounds, or how many TED Talks the CEO's done, the price you pay still matters. If you overpay, you can still lose money, even if the company does everything right. It's the same with ETFs and mutual funds. Apple seemed invincible when it was going up 8.5x in 3 years. But the 80% drop over the next 9 months proved it wasn't. Overpaying for great companies is one of the biggest mistakes people make when they start investing. And it's just the tip of the iceberg. So today, we're going through 10 things you should never do when investing in the stock market, because avoiding these is just as important as doing the right things. Number 1, never chase past performance. Every prospectus says it, but nobody listens. Past performance is no guarantee of future results. Yet, the number one reason most people buy a stock or fund, because it's already gone up a lot. That's not investing, that's trend chasing. If you only buy what's hot right now, you're gonna end up buying high and selling low on repeat. The best time to invest in something is usually before it's on the cover of a magazine, not after. The main reason this doesn't work is because the stock market doesn't work like anything else in life. If you go to a restaurant with a 5-star rating, it'll probably be good because they're gonna use the same ingredients for you that they used for everyone else. In this case, past performance is indicative of future results. If you go see a movie with great reviews, you're gonna see the exact same movie everyone else saw, so you'll probably like it too. But when it comes to investing, the future is always different than the past. And the current price of any investment is always based on what is expected to happen. But we can't perfectly predict the future. So if things are better than expected, the investment will go up. If they're worse than expected, it'll go down. Well, the better investment does, the higher the expectations will get. And in order for it to go up, it has to do even better than what's expected, right? Well, the higher the expectations are, the harder they will be to overcome. So the better an investment does and the more optimistic people are about it, the more likely it is to fail going forward. It could be one of the greatest companies in the world, like Apple turned out to be. But when everyone thinks something will do well, that's a sign that the upside is probably mostly priced in. That's when it's most dangerous. And that's why it's not a good idea to just buy what's being hyped up because it's already been doing well. It's not just legal language. Past performance really is no guarantee of future results. Number 2, never try to time the market. Yes, if you magically bought at the bottom and sold at the top, your returns would be incredible. But that's not a strategy, that's guessing. And statistically, people are terrible at guessing. If you miss just the 10 best days in the market, your long-term return gets cut in half. And those days usually come right after a crash, when most people are in cash, waiting for things to calm down. Trying to time the market sounds smart, but for the vast majority of people, it turns out to be a terrible mistake in the long run. Number 3, never invest without a plan. Throwing money into the S&P 500 and hoping for the best is not a plan. Neither is buying a stock just because a friend told you it's the next big thing, or Bitcoin, or the new hot ETF you saw a YouTube video about that sounds like it's all upside and no downside. Anything could make sense as part of your plan, but without a plan, how do you know? You need to start with why are you investing? Why do you need the money? How much risk are you comfortable with? And what will you do when the market drops 20%? Without a plan, your portfolio becomes a collection of random guesses, some up, some down, and no real direction. Would you build a diet and exercise plan without considering your goals? No, of course not. You'd start with something like, I want to lose more weight, or I want to build more muscle, then decide what you need to accomplish that goal. Investing works the same way. The right ingredients for your goals might not be the same thing that someone else needs for their goals. If you don't start with a plan, you're probably not giving yourself the best chance to be successful. Number 4, never confuse a good company with a good investment. This is a classic rookie mistake. You love the company. You use the app every day. The product changed your life. That doesn't make it a great investment. Even great companies can be terrible investments if you overpay. And bad companies can sometimes be decent investments if the price is low enough. Well, you remember our Apple example from earlier. Well, in 1999, it may have seemed invincible, but a few years before that, it was on the verge of bankruptcy. By all accounts, this was a bad company that turned out to be a great investment. Then it was a great company that turned out to be a bad investment. And eventually, in the long run, we all know it turned out to be a great investment. But it's a perfect example of how both are possible. When you buy a company, you're not just buying a brand. You're buying an asset that needs to grow in value. Don't let your emotions write the check. Number 5, never go all in on one bet. Yes, some people put all their money in one stock and got rich. But for most people, it doesn't work out. Remember, there are also some people who've won the lotto. That doesn't mean it's a good investment plan to put all your money in lotto tickets. Even a seemingly safe company can go bankrupt if there's some sort of scandal or accounting fraud. It's just not worth the risk. Even professionals diversify. You don't need 500 positions, but you do need a mix. One lawsuit, one earnings miss, one regulatory change, and your sure thing could tank 40% overnight. Diversification doesn't guarantee profits, but it does protect you from disaster. And that's a huge part of long-term success in investing. Number 6, never confuse yield with return. But Kyle, I'm getting 12% a year. Great, but if the investment is losing 10% in price, your actual return is closer to 2%, maybe even less after taxes. Yes, high yield investments can look attractive, especially when the stock market is choppy. But always ask where that yield is coming from. Some funds generate income by selling off upside, which limits their ability to grow. Others are just slowly returning your money to you with a nice label on it. If it sounds too good to be true, it probably is. Number 7, never obsess over fees, but don't ignore them either. Fees do matter, but they're not the only thing that matters. A cheap fund with a bad strategy is still a bad investment. Yes, you should avoid paying 1.5% fees for something that just tracks an index. And if 2 index funds are exactly the same, you should go for the one that costs less. But if a skilled manager charges 0.5% and has consistently beaten that index for decades, net of fees, that can be worth paying a little more for. Think about it in the grand scheme of things. Sometimes people obsess over 0.2% and fail to consider the actual differences in what you're getting, when they could be 10x that much. Think about your food. You definitely don't eat at the cheapest possible restaurant for every meal, right? Fees are like restaurant prices. Don't just look at the bill, ask if the meal was actually good. Number 8, never let emotions drive your decisions. Markets go up, markets go down. That's the way the world works in the short term, but they go up in the long run. If you want to capture those long-term gains, the best way to do that is to stick with your plan. If you panic every time stocks fall, you're locking in losses in something that goes up over time. Why would you do that? It sounds illogical, and it is, but the problem is that most people don't invest with logic. They invest with emotions. And when you do that, you're not really investing. You're just reacting. And emotional decisions are usually bad ones. Don't change your strategy because of one scary headline or a red day on your app. That's how people end up selling low, locking in losses, and swearing off investing until it feels safe again. But by the time it feels safe, you've already missed the recovery. This may sound easy, but when times are stressful and uncertain, it is the hardest thing to do in investing. And it's also the main thing that sets apart the most successful investors from the average. It's not rocket science. All you have to do is invest based on your objectives and don't change anything unless your objectives change. But it's a lot easier said than done. Number 9, never take advice from strangers who don't know your situation. I just bought this ETF. It's the best. Best for who? What's your age, income, goals, risk tolerance, tax bracket, account type? If they don't know that, they're not giving you sound advice. They're just talking. And are they even qualified to give advice? That's a whole separate topic, but I digress. The point here is there's no perfect portfolio for everyone. What works for a 22-year-old building wealth probably isn't going to work for someone retiring next year. Advice without context is just noise, so be careful who you listen to. Number 10, never underestimate the power of time. If you only remember one thing from this video, make it this. Time is your most powerful investing tool. You don't need to make perfect picks. You just need to be consistent, diversified, and stay in the game. Even average returns turn into serious wealth if you give them enough time. That's not hype. That's how compound growth works. The eighth wonder of the world. Most people don't fail because they picked the wrong fund. They fail because they started too late or quit too soon. So if you haven't started yet, what are you waiting for? So there you have it. 10 things you should never do when investing in the stock market. Some of these are obvious. Others seem heartless until you learn the hard way. But together, they can make or break your long-term results. You don't need to predict the future. You just need to avoid the classic mistakes. And remember, this is not financial advice. It's just how I think about it based on experience. Hey, and last thing, my business partner, Ethan, and I, we have a free Discord of over 500 members. If you want to join that, you can check out the link in the description below. Thanks for watching, and I'll see you in the next video.